Semiconductors and the analog space continue their weakness. While the industry is notoriously cyclical, this trough seems a lot harsher than usual. And the business that we're discussing today has been hit very hard in this down cycle. That's the bad news. The good news is their stock is actually holding up pretty well, and growth is now expected to happen in the second half of calendar year 2024. This business is Microchip Technology, ticker MCHP. Welcome to the Quality Investor. Microchip Technology has been a strong holding of mine. This manufacturer of microcontrollers and microprocessors has had a rough 18 months, however. One bright spot for this business, though, has always been their cash generation. I adamantly contend that free cash flow growth is the precursor to share price growth, and Microchip generates a healthy amount of free cash flow. On top of that, they return that cash to shareholders through a rising dividend and share buybacks. But we're here to discuss yet another dismal quarter and what that means as an investment going forward. Before diving in, remember to hit that like button and subscribe to the channel so you can stay up to date on all the quality businesses in the market. When earnings were released, I was a bit surprised. They missed on the top and bottom line numbers and provided pretty weak guidance. Earnings came in about 0.2% lower than expected, and the revenue came in about 1.2% lower as well. I was surprised because I was expecting a pretty hefty fall in the market. It fell a bit here in the after hours trading, but it seemed to hold up quite well since then. I mean, it's even up 2.27% in the past 5 days. The market certainly is a mystery sometimes. But as we'll see in a minute, I did lower my target buy price for Microchip because of this earnings. I will say this, last quarter, Microchip CEO Ganesh Moorthy did an excellent job priming investors and the market in general about how bad this quarter would be. So there was a strong expectation on my part that things would be ugly. The market felt the same way, as evidently these poor expectations were priced in. We were not blindsided as investors in the same way that the poor Starbucks shareholders were blindsided. Looking at their income statement for the quarter, we can see a $1.3 billion in sales. That is down from $2.2 billion a year ago, a 41% drop year over year. For the year as a whole, March 31st is actually their year end. They were down 9.5% to $7.6 billion in sales. Gross margins were also down. They were down 2.1%. down to 65.4% for 2024. And the same story for the operating margins. The operating margin came down to 33.7% for the year, down from 36.9% last year. I always discuss margin contraction on this channel as one of the biggest destroyers of value. And that certainly did not help the earnings per share, down to $3.48, a 13.4% drop from the last quarter. On the earnings call, the management attributed this to the weakness in the broader macro environment. However, they did mention two areas that remain strong: their aerospace, and even more interestingly, their AI data centers. AI data centers seem to be the prime growth area right now in the tech world, so I do see that as a good thing. And of course, because of that weakness in the market, there's going to be a lot lower demand, and that means factory utilization is down. That's what's squeezing the margins right now. Once they get their factories back up to 100% capacity, their margins are going to grow again. All in all, it was the same story as last quarter. However, one thing about the semiconductor industry is that it's cyclical. And after the lows of the cycle, there are also very big highs. Here's a chart that I put together for the revenue growth percent year over year. Since 2007, for the semiconductor industry, you can see that cyclicality in the revenue growth up and down. In the last fiscal year, they had negative 8.83% growth. Like I said in the beginning, this trough seems harsher than normal, and you can see it's the worst since 2009 when they had negative 10.7% growth year over year. This is a slide from the Microchip Earnings presentation. Strong cash generation through the cycles. You can see this line is an overlay of that revenue cycles over time. However, the blue shaded area, that's their free cash flow growth since 2007. You can see it's grown at 12.2% annually since then. Like I said at the beginning as well, Microchip generates a lot of free cash flow. And at the end of the day, that's what us as investors get as a return. Let's come over to their guidance. So for the fiscal first quarter 2025, they're guiding revenue down to $1.2 billion for the quarter. That's still a decline sequentially and year over year. It was this guidance that also led me to think that share price was going to take a bit of a tumble in the market. But on the earnings call, management stated a couple different things. They said that they expect their June to be the bottom of the cycle for both growth and margins. You can see that they have gross margin at 60%. And then long term, those are getting back up into the 67 to 68% range. Once their capacity comes back online, their growth margins and their operating margins down here, they're going to grow. They're going to get back up to their long-term ranges here. And another thing that they noted was that the average selling price of their products, that has remained consistent, meaning Microchip is not lowering the prices as a tool to drive further demand. So they still have pricing power. And some other notable items on that call, they're seeing their cancellations subsiding. Their bookings are picking up. So the February had the highest bookings in 8 months. March was the highest in all of 2024 fiscal year, and April was even higher than March. So they're getting new bookings. They're getting shorter lead times as well, meaning customers are wanting inventory faster. And they've also seen customers expediting shipments. So there are some positives that were on the earnings call, and they may have staved off a larger drop in the market. And one more thing I caught on the earnings call, in July, they're announcing that they're entering the 64-bit embedded microprocessing market. Here are the different markets that they're in now. They said that they're introducing a suite of products for high performance embedded processing applications that include AI solutions. And you can see here they have AI in their Internet of Things, their data centers, and as well as autonomous driving. 3 major growth drivers right now, not only for Microchip, but for a lot of areas in the economy. And not only that, they're also higher margin. At least that's what management is stating. So if they continue to grow that area of the business, that means their margins are going to be pushed up further still. The last thing from their presentation that I want to highlight is their consistent, disciplined, and balanced capital return strategy. Since 2019, they've returned $12.3 billion to investors. Here's a breakdown of how all that is played out. Debt, about half of that, and then dividends and shares repurchased. What's interesting here is they're targeting 100% of free cash flow by March of 2025, meaning they're going to have all their debt paid down by the end of the year. After all that free cash flow is just going to be coming back to us shareholders through dividends, a growing dividend, and share repurchases. Their dividend, by the way, just grew 18% year over year this year as a part of the announcement for the earnings. And they're also about 3 years away from becoming a dividend aristocrat. And one nice thing about their dividend, it doesn't grow every year. It grows every quarter. So like I said at the outset, I did lower my target buy price. So what does their valuation look like? So I mentioned that cyclicality earlier. Here's the growth rates I'm projecting for Microchip. In 2025, I'm actually projecting about a 30% decrease in revenue year over year. The main reason for this is that their early quarters of 2024, their Q1 and Q2, so those good quarters are the high starting point for our year over year comparison in the first couple quarters of 2025. So they're going to have a very drastic drop year over year for the first couple quarters. And for the year as a whole, that's going to be 30% downward. But with that cyclicality, that means they're going to have an upswing the next few years. So we're projecting 26% up in 2026, 15% in 2027, and it slowly tapers off to about 4.3% growth through the end of 10 years. Ultimately, that's only a compound annual growth rate of 2.87% for the revenue. Free cash flow, on the other hand, that's only growing at 1% over the next 10 years. So they're not growing drastically, but what they are generating in cash flow, they are returning that to shareholders. For the operating and net margins, I have the operating margin expanding to about 35% at year 10 and 26% for the net margin. I want you to keep this in mind because if you look at the historic growth here, it's well below what they've done historically from a free cash flow growth standpoint. That's important because if they grow any more than this, then they're going to be quite undervalued right now. But I am using the 1% as my base scenario for Microchip. I did want to show you what my bear and bull case growth rates were as well. So for my bull case on revenue, I have them growing about 6% for the next 10 years. And for free cash flow, I have the bull case at 5% over the next 10 years. For free cash flow on the bear case, I actually have that falling at just under 0.5% per year for the next 10 years and revenue growing at only 2% for the next 10 years. You can see here for my bear and base case, I'm not that bullish on their revenue growth in general, but if they do grow, it's going to grow quite a bit. So putting that all together for Microchip, this is what we're looking at here. So we have a $91.99 share price right now. I have their DCF base case at $84.36. Their dividend discount models at $126.65. This assumes about 12% growth in their dividend. And they have an exit multiple price of $106.53. That's about at a 30 median PE for my comparables. Using the weighted average here of my bear, base, and bull probabilities, 25, 50, and 25%, the buy price with no margin of safety would be at $104.40. So it appears even with these very modest projections, there is some real upside here for Microchip. Of course, this is no margin of safety. I would prefer about a 20% margin of safety for Microchip, and that's what I've been using when I have been buying Microchip, about a 20% margin of safety. I had my buy price previously at about $85.50. So after updating for this quarter, I did get a lower output here to $83.52. So right now at $92, it's quite a bit higher than what my margin of safety is. So I personally will not be buying any Microchip anytime soon. But this is a very volatile stock. So I think just a couple months ago, it was in like an $80 range. And at that point, I would definitely pick up some more. With a stock like Microchip, volatility is your friend. So while I think there's really good upside for Microchip, especially if it hits its bull case numbers, this is a stock that I'm going to be holding off on until it falls down to a much more reasonable price. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.